Everyone waiting for the Australian housing market to crash believes the same quiet thing, that when prices fall, they'll finally get to buy. But that's not how property crashes actually work. By the time prices drop, the bank's already begun tightening the lending. Your borrowing power is lower, your job feels less certain, inflation is still quietly eating your deposit, and the agents are already whispering that the first little dip is the bottom. So yes, house prices can fall. That does not mean that housing gets easier to buy, as sad as that might be. In fact, this might be the most dangerous phase of the cycle. The phase where the numbers on the chart go down and the people watching are cheering right before they're trapped on the sidelines. Today I want to walk you through why falling prices won't rescue buyers, why the national headline is hiding what's really happening, and why the first bounce off the bottom is the exact moment most people get caught, cycle after cycle. So stay with me because the last section changes how you should read every property headline for the next 5 or so years. So let's start with the thing nobody wants to say out loud, and that is prices don't fall because the market suddenly becomes generous. Prices fall because credit is disappearing. And when credit disappears, it disappears for buyers too. Think about what actually pushed this market over the edge. The RBA delivered 3 straight rate hikes in February, March, and May of 2026. That dragged the cash rate from 3.6% all the way up to 4.35%. That single move completely reversed the rate cutting cycle from the year before. Now, here's the part that matters most for you and I. Lenders don't test you at 4.35%. They stack a 3% serviceability buffer on top of that rate. So the bank's quietly asking whether you could survive repayments at more than 7%. And in February 2026, APRA added a hard cap. No more than 20% of new lending can go to borrowers stretching past 6 times their income. So let me put these pieces together for you because this is the whole game. We'll go through the numbers together. Rising rates make sellers panic, but they also shrink what you're allowed to borrow. A weakening economy drags prices down while simultaneously making your job less secure. Ultimately, the forces weakening the seller are hitting the buyer just as hard. That's the trap. You were promised a cheaper house, yet what you actually get is a cheaper house that you can no longer finance. But here's where it gets interesting because the headline number is designed to hide all of this. When you see Australian house prices fell, you picture one big red line falling for the whole country. That's obviously not how this works, or at least I hope it's obvious. The market doesn't crash like a light switch flipping off. It rolls over like a heat map, one region at a time. The national index fell 0.4% in June of 2026. That was the biggest monthly drop since December of 2022. The market peaked back in March and it's been drifting lower ever since. But the single national number is blending together completely different worlds. Sydney fell around 1.1% in that month and Melbourne fell about 1%. Meanwhile, Perth was still up 0.7, Brisbane still up 0.3, and Adelaide was still grinding higher. So the average looks okay for now, but when we pull these the data apart, we can see what's actually happening, and it paints 2 different stories. Auction clearance rates slipped below 50% for several weeks in June of 2026, dipping as low as 47% nationally, before recovering to just under 50% by early July. Below 50% means, on average, more homes fail to sell than are selling, at auction that is. This power is shifting from the sellers to the buyers in real time. This is what it looks like, but the tops are a process. Sydney values have already fallen roughly 2% from their peak back in November of 2025. The crash is actually a process. As we said, it's starting from the inside out. So now let's be careful here because next part gets a little bit misreported consistently in the media. Perth has not crashed, and I know I've used that term before, but we're seeing signs of a downtrend. Perth is actually our early warning sign. Homes in Perth were taking around 18 days to sell in June of 2026, still fast historically, but slower than earlier in the year. Listings had risen to roughly 6,100 properties, more than double the same time in 2025. That is a market still running hot on the surface, and yet pace of growth is fading, month by month from a sprint down to a jog. That's the pattern we've seen before with Sydney, Melbourne, and possibly soon in Brisbane. Late cycle rollovers usually start with the strongest cities quietly running out of momentum, one suburb at a time, long before the national annual numbers catch up. By the time the yearly figure confirms it, the turn already happened months ago. Now, every time someone points at a correction, one word gets thrown back at them like a shield. I hear this all the time: immigration. The argument goes roughly like this. Australia's still bringing in record numbers of people, so prices simply can't fall. And there's truth in the demand. There were 2.98 million temporary visa holders in the country by the start of 2026. Net overseas migration ran at 295,000 for that year. That's real pressure on shelter. But here's the piece of the argument that always misses. Immigration supports the demand for a place to live. It does not automatically support the demand to buy at peak prices, because a new arrival needs somewhere to sleep tonight. That fills a rental property. It does not mean the bank hands them out 900 grand to go and outbid you on a new house. It might feel like that, but that's not what's happening. Look at how the influence actually splits. Some economists, including former Treasury economist Leith Van Onselen, argue migration plays a much larger role in driving rents than in driving house prices. Immigration is a rent story far more than a price story. So it can keep vacancy rates crushed, which is what is currently happening when you look at the data. It can keep rents climbing, also what we're seeing. It just can't force borrowing power that doesn't exist. Immigration keeps people renting. It does not keep buyers borrowing. And that distinction is the difference between a market that's supported and a market that only looks supported. Which brings me to the part of this that almost nobody is measuring correctly, at least in my opinion, because there's a version of a crash that never shows up as a falling house price at all. So let's have a look at this. Right now, headline inflation is sitting around 4% in the year to May of 2026. The underlying trimmed mean measures actually rose to 3.6%. That's the sticky number, and it's still sitting above the RBA's 2 to 3% target. Housing costs specifically were up 6.5% over the year. Electricity alone jumped 21% as government rebates rolled off. Now hold that inflation number next to the price of your house. Imagine a house whose price stays perfectly flat for a year. On paper, nothing happened. The number didn't move. But if everything else got 4% more expensive around it, that flat house price quietly lost about 4% of its real value. Do that for 5 years and the paper price barely moves. Paper price. So that barely moves, while the real value bleeds out underneath. That is the crash you don't see coming. A slow, silent erosion hidden behind a number that looks completely stable, at least to the masses. And this is what I think most people are going to miss over the next 5, 10, possibly 15 years. They'll wait for a headline that says prices have collapsed 30%. Meanwhile, the real damage happens quietly in a currency that's losing value while the price tag pretends everything is fine. And if you think you can just wait this out until it gets cheaper, I need to show you where affordability actually stands right now, because it's not drifting towards better. It's being attacked from both sides at once. According to the National Housing Supply and Affordability Council, it now takes 11.2 years to save for a deposit. Back in 2015, that was 9 years. Servicing a new mortgage now eats nearly 46% of the median household income. Anything above 30% is officially housing stress. And we're sitting at nearly half our income now just to pay those back. And renters, the people trying to save while they wait, are handing over a record 33% of their income just to keep a roof over their head. Absolutely sucks, I get it. Reports suggest only a small fraction of median income households can actually afford the median home, with metrics like the 46% servicing ratio pointing to severe housing stress. So think about the position of a person waiting for a crash. They're paying record rent, which drains the deposit they're trying to build. They're chasing a deposit target that keeps getting further away, and they're being told to just be patient. Buyers are waiting for affordability to improve, but affordability isn't improving. It's being crushed from the price side and the financing side simultaneously. Now, here's the move that tells you exactly where we are in the cycle, because there's a rhythm to how the system behaves. At the top, the system adds credit. It loosens, it lends, it leverages everyone up to the eyeballs. At the top, the system does the opposite. It quietly starts pulling leverage out of the markets. And that's exactly what's happening right now. From the 10th of August 2026, self-managed super funds can no longer borrow to buy residential property. New leveraged arrangements are restricted to commercial property only. Now, on its own, this is small. Self-managed funds are under 1% of all residential borrowing. They hold tens of billions of dollars in residential real estate. So no, this one change doesn't crash anything. What actually matters here is the direction. This is just one example of a broader pattern. So we stack it together. Rising rates, squeezing borrowing power, A 3% serviceability buffer testing you at over 7%, a hard cap on high debt to income loans, and now a category of leverage buyer being switched off entirely. Every one of these makes it harder to borrow the same amount that was easy a year ago. The taps that were wide open on the way up are being tightened one by one on the way down. That is a rug being pulled slowly while the price charts distract everyone. And this is where the real trap shows up. Markets don't fall in a straight line. They fall, they pause, and then they bounce. The old up, down, and sideways, right? Here's the pattern that plays out every single time. The market runs hot, it cools off, prices dip, then a small rebound arrives. Complacency. And that rebound is where the psychology turns really dangerous. I've seen it myself in people that I actually care for and respect a lot. People see the bounce and decide the danger has passed. The agent sees on it and starts selling one message. The bottom is in, buy the dip. You're missing the window of opportunity, and a wave of buyers rushes in, convinced they've timed it perfectly right into the next lower high. Then the market rolls over again. Lower high after lower high after lower high. Domain's chief economist, Dr. Nicola Powell, put the danger perfectly. She warns that buyers waiting for a market floor risk missing it entirely because the downturn is often short and the true bottom only gets identified in hindsight, once prices are already rising again. But flip that around. The same blindness that hides the real bottom is what makes the fake bottom so convincing. I know it gets a little bit crazy, but bear with us. The first bounce after the drop is actually the most dangerous moment in this entire cycle. We see it across all markets, mind you. Cryptos, Bitcoin, the stock markets, commodities. It's human psychology. Because that's the moment everyone lets their guard down, right before the trap takes its second bite. So let me leave you with something you can actually use, because I don't want this to just be a doom type video. If you're waiting to buy, stop staring at the price. The price is the number designed to fool you. Watch borrowing power instead. Get yourself set up with a bank loan, not to say you have to use it, but at least it's prepared in times when credit is much easier. Watch the serviceability numbers, because as Cotality's head of research, Gerard Berg, put it, rate hikes have completely offset the benefit of price drops in the biggest capitals. Let that sink in, because in Sydney and Melbourne, prices actually fell and buyers were still no better off because the cost of servicing the loans rose faster than the price drops. Meanwhile, in Brisbane, a median buyer needed over 17 grand more household income just between January and May of this year to service the same mortgage. In Perth, it's about $16,500 more. Even at the entry level, the lower quartile homes, the income needed jumped $14,500 in a matter of months. So focus on the income you'd need rather than the sticker price. So, the price that the property is listed at. Watch unemployment, because a weaker job market is what tightens credit even further. Watch inflation, because that's the silent tax draining your deposit while you wait. And watch the suburb itself. Ask the real questions. Is this place actually becoming affordable for someone like me, or are buyers like me simply being removed from the market one by one? Because here's where we land. The property crash might genuinely arrive. The prices might genuinely fall. But it won't arrive as a bargain wrapped around a bow waiting for you to walk in and just buy this damn thing cheap. It'll arrive as tighter credit, weaker jobs, sticky inflation, and fake rebounds sold as safety. It'll arrive as a house that's cheaper on paper in a world where fewer people than ever can borrow enough to buy it. That is a trap disguised as a discount. And the people who understand the difference are the only ones who won't get caught in it. So before you celebrate the next falling price headline, ask yourself the only question that actually matters. If prices fall, will you still be able to buy? If this reframed how you're reading the market, subscribe, because I'm tracking this rollover city by city as it unfolds over on Instagram and on this channel here. I'll leave a link to those in the video description. I'll see you guys at the next video. Until then, take care and peace out.